In this video, we are going to talk about dividend stocks for cash flow. So before starting this video, please like this video and subscribe to this channel for our future updates. A cash dividend is a payment of funds or money made to stockholders as part of the company's current earnings or accumulated profits. Cash dividends, as opposed to stock dividends or other forms of value, are paid directly in money. Most brokers provide you the option of reinvesting or cashing out dividends. Cash dividends are a traditional means for firms to return capital to their shareholders in the form of quarterly cash payments, while certain equities may pay these bonuses monthly, annually, or semi-annually. While many companies pay regular dividends, other companies pay special cash dividends to shareholders after one-time events like court settlements or borrowing money for significant, one-time cash payouts. Each company creates its dividend policy and evaluates it on a regular basis to see if a dividend decrease or increase is necessary. Dividends are paid out in cash on a per-share basis. Chevron, CVX. Chevron was founded in 1879 after an oil field near Los Angeles was discovered that produced 25 barrels of oil per day. Chevron is now one of the world's largest oil firms, producing about 3 million oil-equivalent barrels per day. The majority of Chevron's income come from exploring for and producing oil, gas, and liquefied natural gas, but the company also owns refineries that use crude oil to manufacture petroleum products like gasoline and petrochemicals. Chevron and its predecessors have paid unbroken dividends since 1912, despite operating in a highly cyclical industry. Many competitors have come and gone during Chevron's existence, demonstrating the competence required for the company to succeed. In short, Chevron has demonstrated its ability to manage costs, which is critical given that profits are dependent on commodity prices, and make sound capital allocation decisions. Chevron has built a large scale by purchasing rivals during downturns and consistently reinvesting profits to enhance the exploration and production of new oil and natural gas sources, giving the company a long-term advantage over competitors. Chevron, for example, has amassed a wide portfolio of assets, including heavy oil, deepwater, natural gas, conventional oil, and shale. Chevron's operations also extend over the world, including main producing zones in North America, South America, Australia, Asia, and Africa. Chevron's varied asset base allows it to maximize profitability across commodity cycles and decreases the chance of a single project failure having a significant impact on the company, a luxury not available to smaller competitors. Vertical integration strengthens the oil giant's competitive position even further. Chevron is involved in all parts of the fossil fuel industry, including the production of refined goods such as gasoline, diesel, and petrochemicals. These downstream operations use crude oil as input and profit from low oil prices, allowing the company's cash flow to remain stable during difficult times. Chevron has also been able to grow and diversify without sacrificing financial flexibility. Standard & Poor's has given the company an AA credit rating, indicating that it has one of the best balance sheets in the industry. Chevron can enter unanticipated downturns in oil prices with the flexibility to make opportunistic investments and maintain its dividend track record until the climate inevitably improves, because to its relatively modest leverage. Duke Energy, DUK. Duke Energy, which was founded in the early 1900s, is one of the country's largest regulated utilities, with operations across the Southeast and Midwest. Electric utilities account for over 85% of the company's net income, followed by gas utilities and infrastructure at 10% and commercial renewables at 5%. Duke's stable cash flow stream, which generates more than 90% of earnings from regulated activities, has allowed the company to pay quarterly dividends for more than 90 years and increase its dividend every year since 2007. Duke's strong position should continue to sustain a rising dividend. 4 of the top 8 states for population migration are served by the corporation, including Florida, almost 25% of net income, and the Carolinas, over 35% of profits. Duke's utilities are located in areas with historically constructive regulation, in addition to good underlying consumer growth. Activist investor Elliott Management calculated that Duke operates in the top 20% of jurisdictions in the country, based on rate base. This is significant because state utility commissions determine the rates that utilities can charge their consumers and supervise their investment plans. Overall, Duke believes it is well positioned to achieve 5% to 7% annual profits per share growth over the long term as it invests in its infrastructure and expands its renewables portfolio. As Duke strives to reduce its payout ratio, the dividend will increase at a slower pace for at least the next several years, but income investors may expect mid-single-digit growth in the long run. Brookfield Infrastructure Partners, BIP. Brookfield Infrastructure Partners, BIP, a master limited partnership, controls more than 30 infrastructure assets, including electrical transmission lines, railroads, ports, natural gas pipelines, toll roads, telecom towers, and data centers. Around 95% of BIP's cash flow is supported by regulated or long-term contracts, about 75% is inflation-indexed, and about 60% is volume risk-free. The majority of the company's customers have investment-grade credit profiles, lowering the danger that they may default on their obligations. Since being spun out from Brookfield Asset Management in 2008, these features have allowed BIP to increase its distribution year after year. Management expects the company to maintain its 5% to 9% annual distribution growth target in the future. Inflationary pricing rises, volume upside from global GDP growth, and cash flow reinvested throughout BIP's enormous backlog will all drive growth, which will be backed by the firm's BBB+ investment-grade credit rating. Income investors should be aware of the partnership's tax structure if they are drawn to BIP's key infrastructure and unusual combination of income and growth. Because BIP does not generate unrelated business taxable income, it can be owned in retirement accounts, unlike many limited partnerships. For investments held in taxable accounts, however, investors will receive a K-1 form. Investors who want to avoid having to fill out K-1 tax forms should be aware that BIP will split its shares in 2020 to form Brookfield Infrastructure Corporation, BIPC. BIPC has a similar economic return and payout as BIP, but because of its organizational structure, its investors receive the same dividend reporting slips. However, each entity has its own set of tax implications. BIPC withholds 15% of its payment to U.S. investors who hold shares in taxable accounts because it is a Canadian firm. A foreign tax credit may be available to investors. BIP, on the other hand, is based in Bermuda. Because a large amount of its payouts are generated here, they are fully taxable as regular dividend income rather than the lower rate that qualified dividends enjoy. Dividends generated in the United States and Canada account for a modest fraction of BIP's distributions. These are qualifying dividends, and U.S. investors may be subject to withholding taxes on Canadian distributions. To avoid some of these concerns, it may be best to hold BIP or BIPC in retirement accounts for the sake of simplicity. Canadian Natural, CNQ. Canadian Natural is the country's largest independent heavy crude oil producer as well as its largest independent natural gas producer. Unlike its integrated contemporaries, which own midstream and marketing companies, the company makes almost all of its money from upstream operations. Despite its oil price sensitivity, Canadian Natural has paid greater dividends for the past 20 years. This outstanding track record may be attributed to the company's huge scale, high-quality resource base, fiscal discipline, and ownership of midstream assets, which minimize transportation costs and enable its products to reach worldwide markets at the cheapest possible prices. Given its emphasis in Canada's oil sands, Canadian Natural's asset base is notably distinctive when compared to conventional oil producers. Bitumen, sand, fine clays, and water are mixed together to make oil sand. It must be mined or heated underground before it can be processed because it does not flow like normal crude oil, resulting in comparatively high fixed costs. The long-life, low-decline nature of oil sands reserves, on the other hand, results in a low cost of production. Canadian Natural estimates that at a price of $30 per barrel, it can pay its dividend and continue capital expenditures. The company is also managed with a low level of leverage, earning Canadian Natural an investment-grade credit rating. This allows the company to rely on its balance sheet to maintain dividend during downturns. Overall, investors evaluating the company should be aware that it is a very volatile industry, driven by Canadian Natural's focus on upstream activities and the challenges of producing oil further away from attractive markets like the Gulf Coast of the United States. The current oil and gas prices have a significant impact on dividend increases in any given year. However, we believe Canadian Natural will continue to be one of the few safe choices for income in the difficult energy market. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.